look at the last 9. Okay. See, Prosperity always closes their account to 30th May. So on 1st June 2012, it's decided to change its year end to 28th February and closes their account to 28th February 2014. Sorry. Apology. This is 2014. Overlap 3 year. Okay. Can we change this? Alright. Okay. Now the numbers given here include the GP, fixed deposit interest, depreciation, then profit before tax. Now, so if you've been given a raw figure, and then you know that there's a counting period given and stuff like that. Now what we normally need to do, see, of course we need to determine your tax basis period, and then later we also need to determine your adjusted income. Okay. Now see, if you look at tax basis period, now your accounting period for Prosperity was 1st of June 11 to May 12, and then June 12 to 28 February 14. Okay, sorry, it's not 13, it's 14. Okay, that's what I intend to do. Now, so what will my tax basis period be? Now, the first one is the original year end, so no adjustment to that. Okay, now I need to determine basis period for Y13. See, for Y2013, now this is not 31st December, and you can see that the change overlap 3 year, 12, 13, 14. So once the change overlap 3 year, now we know what we do is you count how many months are there and divide, right? Okay, so that will be 7, 12, 2, okay, 21. Okay. So 11 months and 10 months. So that will be 31st March 13. And this is Y2014. Now the period that we determine is this. Now what do you do then in your tax com? Now if you want to determine your tax com, you must first determine your business adjusted income. Okay. Now what is the business adjusted income? Now you got to follow your accounts. So if you look at the year ended 30th May and period ended 28th February 14. Now my PBT was 415,1308. So as usual, we minus the fixed deposit interest. Forgot to give you all the maturity date. Okay, 15, 18, and we add back the depreciation, 40, 40. Now that's the only adjustment we have here, right? So we're gonna get your adjusted income as 440 1330. Now, so this amount will goes to Y2012. But how about this amount? The Y2013 and 2014, we got a portioning. So it's just a portion according to the time, the length of the period we have here. So the 1330. So after your portion, you get 969 667. So 696 667. and then 1329,303. Okay, so that's how much adjusted income you will apportion for the respective year of assessment. Okay, now there's the steps only. It's quite similar with the commencement basis period. So you're just going to use the figure and apportion. The only difference is earlier the figure all given. Now the figure you got to calculate yourself. Follow? Calculate, use accounting period, and then you apportion. Okay, that's how you do it. Follow up. Okay, so it's issues on change of accounting date. Right, now we move on. Okay, see, so far in budget 2013, now some of the quite small change that you probably need to know first, because these are assumed knowledge from F6. See, we see the handout. Now, tax rate is not a big issue. Okay, there's a change in the tax rate for personal tax, resident individual. They have changed the rate. Okay. Now, but this rate you follow the table, so you wouldn't see any different anyway. Okay. Now, the second thing that you have to watch out is interest. See, now they introduce section 4 capital B. Okay, they introduce section 4 capital B. Now, this section 4 capital B provides that any interest income that you earn, they will not be business. That means they will only be investment. So the interest income now will always be 4C. Okay, it will always be 4C. So those case law in the past where interest can be 4A is not relevant anymore. Okay, that interest will be 4C. Follow now? Okay. Now see, if the interest 4C, now that include those example of interest like you charge on the trade debtor. Because usually in the past we say if this is your trade debtor, they don't settle the debt on time, you charge interest. Now the late settlement interest is incidental to business. Now because it's incidental to business, what happens? You're going to treat that as business income. But now if you separate it and treat it as 4C, now actually there's a very bad implication. The implication is you're going to have interest restriction. Okay, so because you're having an investment right now. See, last time the investment is all business, so there's no issue about investment. But now, the moment you have 4C interest, this become investment income. So when you have investment income, now we know from interest restriction that the moment you have an investment income and you also borrow money and pay interest. So if the interest you try to claim against the business, the moment you have investment income, you have to restrict it. So SID is going to be a problem in the future. Okay, that as a result of all that, we're going to have an interest restriction on that investment income. Okay, now we'll see restriction again, probably the next class. Okay, so then by then you will see. But that's the law. The law tried to make it simple, but if you look at the intention, probably the restriction is the problem that they try to attack us. Okay, now then number 3, the new rules on tax relief. Okay. Now the main change in tax relief is on this thing. So I just show you the summary first. Now we just take a look at page 18. That means the note. Just turn back to your notes, the front page, page 18. Now see, in these are things I'm just explaining what's the relief. Okay, so the only one I want to focus and explain to you that's new is this. Okay. Now the saving in SSPN. SSPN is Malay lah, Simpanan Scheme Simpanan Pendidikan Nasional. So now English we call it NESS, National Education Savings Scheme. Now last time they allowed a claim up to 3,000, right? Now they increased it to 6. Just remember that, okay? Now the relief is based on net. That means if you withdraw any amount, you must reduce by the amount you withdraw. Okay, so it's based on net. Now besides this saving in SSPN, okay, Broadband, if you recall, this is not new relief. This is the old relief but expired because this relief is effective until 2012. So in the event if you see a question is 2013, then don't claim, please don't claim. Okay. Now, then we have new relief for child. We upgraded the child relief. Now, usually we know relief for child is 1,000, 4,000, 5,000, as well as 9,000. Okay. Now, the 4,000 is given for purpose when the child is pursuing a tertiary education. You study locally, colleges, uni, 18 and above, you straight away get 4. Now, if you study overseas, you only get 4 on condition that you must do a course that's degree level and above. Then you get 4. So now we upgrade 4 to 6. So the level is 6. Just remember 4 becomes 6. Okay. Now then, for the case that if the child is disabled, okay, if the child is disabled and the child is doing tertiary education. Now, last time disabled and do tertiary, let's say for example a child disabled and study a diploma. Last time is 4 plus the 5 become 9. Now it's 5 plus the 6 become 11. So that's why disabled relief is 5, but they get an extra 6,000 the moment they do tertiary education. So the child relief is upgraded. Okay. Now that's all only about the main change that we know from the previous level. Okay. Now, so I'll go through a simple taxcom question. Okay. Treat as revising back the computation format, and there are some of those issues. Maybe I do the time, you probably forgot, then you just pick it up as well. Okay. Now we're gonna see what's the case here. Now we have Johnson with the following sources of income. Now, adjusted income of 100,000, which include 4,000 interest imposed on trade debtor for late settlement of debts. Now, this 4,000 is now 4C. So I'm going to take it out from your adjusted income and put it later on underneath as 4C. Okay. Now, there's a machine acquired in October 2011 for 90,000, caught on fire in April 2013. And then Johnson received compensation 20,000. Now, of course, once the machine is spoiled, it's burned down by the fire, and the moment you claim a recovery, we call this as a disposal, correct or not? So we have a disposal in this case. Now, but one thing I just want to add on is you must watch out for this issue. If you look at the date you acquire and the date dispose, October 2011 to April 2013. Now, this will prompt us into looking at the issue of disposal within 2 years. Correct now. So any capital expenditure that you incur and you dispose them within 2 years, we have this para 71. Okay. Now, so if you have a disposal within 2 years from the date you acquire, there's this para 71 schedule 3 that deals with claw back of CA. Okay, there's this schedule 3 para 71 claw back of CA. That means whatever you claim, we're going to take it back as a balancing charge. But that clawback of CA will not be invoked. That means this rule will not apply on condition if the disposal is something that the DG find it acceptable. Or in the law they say by reason of death or any reason that the Director General finds it reasonable. Now, death, they don't mind. If a person died, you dispose the asset, they will not claw back. Okay. Now, the other one that they say DG find it acceptable is like what? For example, you buy this machine, then you realize that you buy a machine which is not suitable for the business. I can't use it. So what can I do? So I have no choice, I sell it. So if you can justify that it's not suitable, fine. And this is different. This is disaster also. You can't stop me, right? It's a fire. So what can I do? So that's why these are cases the clawback will not apply. Okay. Now, if clawback will not apply, you still need to work out BABC. Because you know, so that's why there will be no clawback, but you will still need to calculate BABC, which of course is different. If you claw back, then you straight away calculate what allows you claim and you charge back. But BABC, you must work out disposal value, okay, then minus with RE. Okay. Now other CA comes to 100,000. Okay, business 2, there's adjusted loss of 70,000. Unabsorbed business loss is 40. Balancing charge is 40. Now there's this frank dividend and interest from convertible loan stock. Now we did mention yesterday that any investment you made on loan stock, the criteria for exemption is it must be non-convertible. So the moment you see the word got convertible, you don't need to ask. Definitely no exemption. So these are interests you must tax as well. Okay. Okay. Now Johnson made cash donation to approved charity 10,000. He donated sports equipment to an approved sports event 30,000, and medical equipment to approved healthcare 28,000. Now healthcare, you can donate cash or medical equipment. An individual can claim up to maximum 20. Okay, so there's some rules to do with donation. Now then the donation for sports as well as project of national interest is restricted to 7% or 10 depending on the person. 7% of your aggregate income reduced by the donation you claim under 44.6. Now all these are the rules on donation. So if you've forgotten, right, then just please run through the notes in page 15 and 16. Okay, just run through the notes in page 15 and 16. Now Johnson's wife has passed away 20th July 2013 due to stroke. So we can only see that, okay, if your wife passed away, so you never mention about your wife income, so we assume that wife got no income. Now, pass away does not stop you from claiming wife relief. You still can claim, so the wife relief is there, okay? Now, Johnson has 3 children. The eldest is physically disabled. He's 20. He's doing a diploma in Taiwan. Now, diploma is tertiary, okay? Disabled child, tertiary, 18 and above. So you're going to get 11,000 relief. Now, if it's disabled, you don't need to check whether it's degree or diploma. All that not important. As long as tertiary, you get the extra 6. Okay. Now the second child is 19 and is doing a degree in UUM. Now if the child is doing tertiary in Malaysia, then again you don't need to check the cost. Whether it's diploma or degree, you still get 6,000. Okay. So the age must be 18 and above. The third child is 14, so you just get 1,000. Now he deposited 8,000 into the SSPN account for this third child, and he withdraw 2,005. So the net amount is 5,005. Maximum is 6, so no problem. Go ahead, you can claim. Okay. Now, so that's the issues we see here. Right, so through answers, we look back into how to apply certain things of the law. Okay. Now we have 2 businesses right now, business 1 and business 2. See, adjusted income is 100,000. Now this machine that you dispose, you're going to get some balancing adjustment. Okay, so what adjustment is that? Now I just show on top, okay, so easier for me. See, my disposal value is the compensation, which is 20. Now I bought this at the price of 90,000. That's YA 11. That's my first year that I will claim IA and AA. Now the rates for IA is 20, plant machine AA is 14, and there will be 1 more year to claim in 2012. $36, $126, Now we get a balancing allowance, okay, 26,008. Now again, if Johnson simply dispose it without any reason, he just for fun just sell off this machine, then the figure would have been different. The figure would have been a balancing charge 43,002, because that will be a clawback. Okay, but now it's not a clawback. You just claim ordinary BABC. Okay, so we get a balancing allowance 26,008. Okay, capital allowance 100,000. Sorry, I forgot to remove the interest just now. Sorry, just notice. Okay, 100, take out the interest. Now, so my CA absorb will only be 96. So statutory income is nil. So that's unabsorbed CA, carry forward. $38. Now in the second business, been told that adjusted loss 70. So we have a loss of 70. You got no income in that year, of course, okay? Now we still have a balancing charge of 40,000. Okay? But that still would give us a statutory income of 40,000. And with the two businesses, you combine the SI, that's the aggregate business SI. So that's the arrangement, that's the format. Now the purpose of this figure is to claim unabsorbed business loss brought forward if you have. Now question said in business number 2, the unabsorbed loss 40 as well. So minus of the 40, nil. Okay, see, business all done already. So you just need to bring in the investment. Now the investment income we have here. Okay, interest is income under 4C. Now your interest will be the 4,000 plus the 20. Okay, 4 plus 20. Now the dividend will be 60 divided 0.75. That's 80,000. Okay, that's it. Now aggregate is 84. See, we have current year business loss that you got to claim first, which is 70,000. Sorry, 104. Okay. Okay. The donation wise, the cash donation to approved institution. Now maximum 7% of 104, which means you can only get 7,280. Now the sports equipment. Now you see, the moment that figure on top is max, then you wouldn't get any more deduction here because you've reached the limit. Okay, but still the working is important. Okay. Now so 7% of 104 minus 7280, left with nothing. And we compare with the value of your sports equipment, which is 30. That's why lower is 0. Okay, so this is how we determine how much you're going to claim. Okay, right, medical equipment maximum 20. So the total income that we have here will be 6720. So our friend will not get any tax definitely because the relief is definitely exceeding this. Now the relief include personal deduction 9,000, relief for the wife 3,000. Now the child relief, the first child will be 11, second child would be 6, third child would be 1. So 18. Then the SSBN deposit, the net saving 5,005. With the relief coming in, Johnson has no chargeable income. Okay, just restrict to whatever total you have, so the CI is nil. Okay, now with no CI, I put the tax here. Your tax payable is 0. But you still have your 110 set off, which comes from the dividend 20,000. So there will be a tax repayable $20. Okay. Alright, so some of the rules that you need to be aware of. Okay. Alright, now we're going to move on and look at issues on employment. Okay. Right, now you see, really employment is an area that's for F6, but they upgrade to P6 with certain new addition. Okay, so they add a few more things. Now, but overall, you still need to know employment very clearly because they can ask anything in employment. Okay, now we divide employment income into 5 types: A, B, C, D, E. Okay, now so how do you distinguish which is which? Now, A is for those that is monetary, as well as perquisite. Okay, so monetary, perquisite. Now B is for benefit in kind. So what's the main difference between a perquisite and a benefit? Now, because both of them is also a kind of benefit. If you really check the dictionary, it's also called benefit. Now, the main difference is, one is you can take it and it belongs to you. The other one is you can't take it. Okay, you can enjoy using the service, but you can't own it. So that's how we distinguish between A and B. So that's why, to distinguish between A, something that the employee will own it. Okay, something that employee will own it. And obviously, it can be convertible to cash. Alright, can be convertible to cash. So that's why if let's say the employer sells car, okay, the boss sells car. So I'm the boss that sells all the car, and you are my worker, and I say I don't mind one of these car if you want. I sell to you at a huge discount. Okay, so I give you a huge discount. Let's say this car, my cost is 50,000. All right, my cost is 50,000. Market value is 80. Okay, but to you as my worker, I just sell to you 10,000. See, I'm going to make a loss out of it. Okay, so, but I don't mind. I sell it to you. Okay. Now, once you buy that car, see, even though the car is my stock, but because the moment you buy it is an asset to you, you can sell off the car again, and then you can raise money. So that's what we say convertible to cash. Can you know? Now that kind of issue is 13.1a. Okay. Now see, of all the 13.1a, the one that is specifically included in P6 is gratuity, shares benefit. Okay, gratuity, shares benefit, and shares benefit may benefit us in many ways. For example, a share scheme and option scheme. So we're going to see different ways of how the share scheme will come in. So we see some yesterday when we deal with overseas transaction, e-source with cross-border. Okay, now we will go back and look at e-source again. Now, see, benefit personally I don't feel is so important in P6 because number one, they don't give you BIK table in P6. So I don't believe that they will test you in here. So probably this is ignorable. Okay, so that's about benefit in kind. Now 13.1c is living accommodation. Now of course this is something that I find it not very important, but came out in the exam also. Okay, so you still need to remember how to do it. Now for cases like employee given a living accommodation, now we only deal with the normal cases. Alright, normal cases. Now the normal cases of employee given accommodation, we will take the lower of 30% times 13.1a or defined value. Okay, usually that's how we determine how much is the value of living accommodation. But for those cases that if you are a non-service director of control company, okay, if your case that you fall as a non-service director of control company, you will use defined value. That there is no more comparison between the two. Okay. Now this is important definition that you always get them in your exam now, okay? Because there's a lot of things that concern this status. So what do you mean by non-service director and what do you mean by control company? Okay? Now you see, non-service director is not defined in the law, but the law defines service. Now service director must be number one, technical managerial capacity. So your job function, okay, your job function, full-time director with technical managerial capacity, maximum you can only own up to 5% ordinary share. Okay, that's called service. That's why a very easy way to tell you a non-service director is I say this guy is a 30% shareholder of this company. Once you own share more than 5, you become non-service. Automatically, you're non-service. Now, controlled company is a company that you can have maximum 50 shareholder. Controlled by maximum 5%. Okay, so control here means more than 50%. That's called control. So if more than 50% of the share owned by not more than 5%, then no issue. Okay. For example, if a company got 10 shareholder equal share, so if 10 shareholder, 10 shareholder equal share, each of them got 10%. Now each of them got 10%, then to control a company, I need 6 shareholder. 6 times 10% is 60, right? Then you can control. That means you're controlled by 6%. Then that company is not controlled. Okay. Now, so that's the only issue that we'll see again and again in the future about this status. Okay. Now, D is for cases that you have withdrawal from unapproved fund. Okay, withdrawal from unapproved fund. Now, see, for funds that they are approved, now funds that they are approved, they can be, one is EPF, EPF. So that's why any withdrawal from EPF, you don't pay income tax, definitely. Okay. Now, private retirement scheme, which is what they now promote, private retirement scheme. They also ask you, you contribute PRS, you can get additional relief, 3,000 together with annuity. Now that PRS, when you withdraw, when you retire, is also exempted, because now the law included the exemption for PRS. Now, but what if I withdraw before retire, which is different with this? I think it's totally not approved. Okay, but PRS is approved. Okay, you know. So for those cases that if you contribute to private retirement scheme and you withdraw them before you retire, now what you're gonna get is withholding tax. Okay. So I just show you where is the note. Okay. Page. The relief section. Where is it? Page 18. Alright. So I just put a note here. Page 18. Okay. Now, see, when you withdraw your money from EPF, it's exempted because EPF is approved fund. Okay. Now, when you withdraw from private retirement scheme, now they also given an exemption in Schedule 6. Okay, that withdrawal from PRS is also exempted. But then the condition is you must be retiring and you withdraw. So if you terminate this early and withdraw before you retire, so if you withdraw before reaching the age of 55, unless it's reason of death or permanent departure from Malaysia, unless with that reason, if not, there will be 8% final withholding tax. Now that one is not here. Follow, it's not here. This is when the funds are not approved. That one is final. So when you receive the amount, it's net. They will totally straight away deduct the tax from you. Okay, you know? Now, so for any withdrawal of unapproved fund, now you just need to take the amount of the employer's contribution together. Okay, take the amount of the employer's contribution together with whatever interest or dividend element arising from the fund. Tax the whole thing when you withdraw. Okay. Now 13(1)(e) is for cases to do with compensation from a loss of employment. Now, so the one that they have in P6 is this, and then ESOS, gratuity. Alright, so these are the P6 syllabus. Now, so I'll go through the first case with you. Now we look at cases on gratuity. Okay, just turn to page 363. Now, see, when you receive gratuity, now gratuity, the common feature is a lump sum payment at retirement. Okay, the common feature is at retirement. Alright, so that lump sum that you receive on retirement is called a gratuity, and we need to first assess whether this gratuity is given exemption. So that's the first thing you do. Okay, so is this gratuity be given exemption? Now, the exemption given on gratuity, now unless you're working in the public sector gratuity is wholly exempted. Okay, now if you're not working in the public sector, then gratuity will be exempted in this way. Now, if this retirement is due to ill health, they get full exemption on gratuity. Now, if the retirement takes place on or after reaching the age of 55, or the compulsory age of retirement specified by the law. Okay, so if there's a law that specifies the compulsory age, and the employment must have lasted 10 years with the same employer or with company in the same group. Now we use the word employer. Okay, we use the word employer. Okay, now if you only work in a group, for example, you work with one subsidy, then after that you transfer to another subsidy, transfer to holding, you move around. These are still called a group, no problem. Okay, now what if I don't work with company, or what if I work with a company that is not a group? Okay, so it can still be the same if the employer is the same. Now this will include, for example, let's say there's this guy called Alex. Now Alex has two companies, A and B. Remember, now both companies controlled by Alex. So let's say Alex holds 90% share in A, 60% share in B. Now this is Alex. Now what happened now? We have Kelvin. Now Kelvin worked with A, let's say for 6 years. Then Kelvin go to B, work for another 5 years. Now, if you look at it, it's two different companies. It's A and B. You don't call this as a group. Alex is not a company. Alex is an individual. There's no group here. Okay, but Kelvin is working with the same employer. So in this case, Alex will be the same employer. So if you want to determine whether the gratuity is exempted or not, now you still take into account from day one when Kelvin in A all the way to B together. Okay, now that's called same employer. Now same employer or group, at least 10 years, 55, full exemption. Now C is something like B but slightly different because we downgrade the retirement age. Now they say that if the retirement takes place on compulsory age, then must still highlight the word compulsory, must be compulsory, that this compulsory age of retirement is pursuant to a contract or a collective agreement, but it's compulsory. It's not optional. It's not that I give you a choice. There's no choice. You have to retire under the agreement or the contract when you come to this age. And the age must be between 50 and above but before 55. Okay, 50 and above but before 55. And same thing, employment lasted 10 years with same employer or company in the same group. Now, so the only difference here is they downgrade the age requirement, but to get this, you must have a compulsory retirement in the contract or collective agreement. That's the key requirement here. Now these are the conditions for exemption. Now what if exemption is not given? See, if you do not get exemption, then how do you assess the gratuity? Now we assess it in this way. Spread over 6 years, if employment began more than 5 years before beginning of the basis period for your cessation. Now, if you cease, let's say for example, you retire on 1st of April 2013, or you retire on, let's say, 31st October 2013. Now, I'm giving two different dates of retirement. But when you determine the 5 year, you must take the date you start until 31st December 2012. So you measure 5 years until 2012. Now, whether you retire in April or October, you will measure until 2012 because it's before the beginning. So the beginning is 2013 and before beginning is December 2012. So you measure it like that. Now, if this period is more than 5 years, then you divide by 6. Okay. Now you will spread over the period. Okay, spread over the period. If it's up to 5 years. More than 5 years, divide by 6. You just spread over if it's up to 5 years. Okay, or anything less or up to 5 years. Follow? Now you see this illustration here. Okay, case 1. Now, Jamie commenced employment with Kangaroo St. Berhad on 1st May 2002. Now, she opted for a voluntary retirement on 30th September when she reached the age of 50, which is an option allowed in the contract. She was given a gratuity of 90,000. Now, what will the implication be? Now, first, there is no exemption to Jamie because the retirement is optional. Okay, now this is case 1. A. Okay, now no exemption because it's not a compulsory retirement pursuant to the contract. Okay, so if it's not exempted, then you must assess. So to assess, you got to work out how long was the employment period. So how do you work out how long was the employment period? So no exemption. Okay, now we check. From the date you start. Now she started 1st of May 2002 until before the beginning of the basis period for your cessation. Now cessation is 2012. So before the beginning is 31st December 2011. So this whole period, is it more than 5 years? It's quite obvious, right? Yes. Now, if it's more than 5 years, then how do you assess the gratuity? Now, then you will spread back 6 years. So, you expect 2012. Now, the year you retire is 12. So, if you spread back, just go back by 6 years. That means 2012, 11, 10, 9, 8, 7. You're going to see 131A, gratuity, $15,000. $90 divided by 6. So revised assessment is necessary in this case. Okay, must go back and revise the prior year. Okay, so this is the case in A. Now we ask now in B. Okay, how would the answer be different if Jamie is compulsorily required to retire? Now, if it's a compulsory age, okay, then we realize that number one, compulsory, her age is 50. Employment from 1st May 02 to 30th September 12. Now will that be 10 years? No? So 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So you must work until April 2012. Now this is May, so this is September. So it's already lasted 10 years. Now it's compulsory. The age is 50. Employment lasted 10 years. Now if that's the case, gratuity will become exempted. So there's a main difference A and B. Okay, so the gratuity is exempted. Right, see case 2. Right, Senkai commenced employment with JSK Enterprise, a business owned by Peter, on 1st February 2000. On the 8th of August, JSK is corporatized and transferred into SinJS Sdn Bhd, a company where Peter held 80% share. And now Senkai continued to be employed by SinJS with a promotion and an increment. Now Senkai retired at the age of 55 on 16th of April 2012. Now what will happen to this gratuity now? Now the issue now is whether the employment with SinJS and JSK be considered as same employment. Okay. Now we know that SinJS controlled by Peter. So Senkai employment in JSK and SinJS is the same employer. Now this time is retired at 55. Now from 1st February to 16 April 12 lasted 10 years. Now since it's the same employer, 55 lasted 10 years, so again the gratuity would be exempted. Okay. Right. Case 3. Now Purva retired from her employment on 30th June 2012 and was paid a retirement gratuity of 126. So if the employment commenced 1st of April 2007 and if the employment commenced 1st of January 2003, now what difference do we see? Now there's no exemption that we're discussing. We are looking at how do you spread back the gratuity. Okay, so in case 3 A, now these are cases that gratuity not exempted. Okay, So if not exempted, then we're going to check from the date she commenced until. Now it's not the retirement, it's before the beginning. So before the beginning of the cessation is 2012, so it's until December 2011. So April 07, how many months we have here? 9 months, right? 8, 9, 10, 11. 57 months, which is not more than 5 years. Now, if not more than 5 years, how do you treat? Spread over the employment period. Now, its employment period is not this period on top. So if you spread back over the employment period, you notice that in YA 12, 11, 10, 9, 8, 7. Now the retirement is June 6, 12, 12, 12, 12, 9. And in total, 63. To determine the treatment, you only count until December. But to spread, you got to follow the actual. So you go back to 63. So we go back to 63, multiply with the gratuity, 126. You're going to get 12,024 and 9. Okay, now this is a case when Puva's employment commenced on 1st April. Now the part B is much easier. Now B, we say what if the employment commenced on 1st January. Now if it's 1st January 03, you still check until December 11. Now this time is more than 5 years. Now once it's more than 5 years, it's spread back over last 6 basis period. So you're going to expect YA 12, 11, 10, 9, 8, 7. So 126 divided by 6, it will be 21. Okay, right, so there's 3 issues to do with gratuity. Now we stop here, okay. Now we will look back into option the next catch-up next Monday, okay. Now there's a public ruling. I gave you all a set that yesterday we see the second part. So next Monday we discuss the first part. So we're going to see different variation, how they can test this option, okay, like what is called releasing option, assigning option, okay. Now so we're going to see that. Then the rest all mainly no change, except we have another new things now on the CA part, how to deal with asset held for sale, because in accounting standard we have a treatment of asset held for sale. So if you have classified in the account asset held for sale, then what do you do in tax? Now last time there's no issue, but now we will deem as disposal. And when you deem as disposal, we're going to work out BABC. But now the question is whether you dispose or not. So that's the rule that we're going to see. Okay. So we'll see all that next Monday. Okay. just take a dinner break, then come back, we continue the class later. I passed the first term note to uncle already, so probably later you can go and ask, see if he ready, then you can further start if you want.